Hey, welcome to Left Right Out. I haven't done podcasts. I've had some issues. I was actually working outside, which is fun. I enjoy labor, so I was doing some jobs for a few people. But then I pulled a muscle in my back again, and man, it's real tough to move around. But anyway, there's simple pleasures about like doing actual laboring jobs where you build something, can look back at on it, and like I built that, and it serves some kind of purpose. So man, I've been enjoying that, and it's been super hot. Been really hot, really hot where I'm at. Well, I guess for the majority of the country, it's been hot. I remember these type of summers when I was a kid or younger, or early 2000s, let's say, like even in up north where you get the 100+ degree temperatures, and we've kind of been blessed ever since then. We're not ever hit that again until just now. But that also brings other stresses, not only to ag communities, when you have certain temp spikes like this, and without any kind of rain. In some of the countries, you're getting just blown out with temperatures and no moisture. In other parts, you are getting a little bit of rain, but as we've seen in the Southwest, there's huge droughts. That's not what I really want to talk about. I'm just going down a rabbit hole, but I wanted to talk about the Federal Reserve and bring that topic up, because what has happened over the last few months has been the Fed speaking out of one side of their mouth and doing another. And it's pretty evident when you look at their balance sheet. Now, it's not like super hard to look this up. You can just Google in the Fed balance sheet and go through and find the chart, and you can actually see what's going on. Now, granted, like I've said before, it's kind of leveled off. But if you actually look at it, this last week it actually increased. So we're still sitting at about 8.99, or it's essentially $8.9 trillion. So they've actually stepped into the market somewhere and have purchased whatever it is. I didn't even look at it, but you can actually pull the balance sheet up and see what assets are in there, because it breaks it down. Treasuries, there are some weird things on the balance sheet. It'd be like, well, that is pretty enigmatic. I don't know what that means, but for the most part, you can look up and see what kind of securities they're holding in general. But regardless of that, they were supposed to be in QT right now. They're supposed to be in QT as of June, and essentially we've seen nothing of the sort. In fact, at best, you can say that they are leveled off and oscillating around this $8.9 trillion range, which is at historical highs still. So, if anything, that's still respective of history. This is loose monetary part. That money is out there and existing, and then you take the the money multiplier effect on that. What the ramifications of that down the line are. We're still significantly loose. Now I can look at it. With 8.99. We can also look at, and here's the conundrum. This is weird. This is kind of what I'm looking at, because there's usually a spread when we look at like the 10-year, which is like a risk-free rate. And I've always said, look at this bond market, and we look at the 10-year, which it was solidly over 3 in anticipation of rate hikes and some increasing geopolitical things and with regard to the dollar. But look at it right now; it's at 2.78%. It's taken a nosedive, or at least yield-wise. In fact, that's more of a bond rally. Because they're inverse. I'm sure most of you that listen to this have some knowledge of that. But if you don't, there's an inverse relationship between yield and the value of the bond. So there's been a huge influx of cash or money into the bond 10-year. Now, there's still, last I checked, there's still a huge inversion from, I believe, in the 2 or the 5 and the 10, the 5 and the 30. And I think the 2 and the 10, I think last time I checked was like Thursday. There's still a huge yield curve inversion, but in the 10-year, every time I come on here, I'm saying these moves are historic, and the move downward in this is historic. Now, here's the other thing about that I'm just bringing up as something I'm just looking at, and it's kind of like blowing my mind a little bit. So if we're getting ready to have, this week we have a Fed meeting where presumably they'll be raising rates again, 3/4 of a point. that's what the consensus seems to be. I mean, some people kind of looking at the a full point going in there. I'm more of the 3/4 point thing. I think they're going to try to play it off and to do as little as possible. And I think right now 3/4 of a point is probably where they're going to be at. But it doesn't matter. That's besides the point. Now, where does it take us if they do that? Well, it takes us at 2.25 to 2.5 because it floats around in there. Now, if you look at that compared to where, and we know this is happening, this is kind of baked in the market, it's happening this week, and yet the 10-year is at 2.78 currently. And if you think about the Fed funds rate will be at 2.25 to 2.5, and to put your money up for 10 years to lock it away in supposedly the risk-free asset, you only get 2.78. That spread, so you're getting maybe 1/4 point to 1/2 point for an additional 10 years of risk. It doesn't make any sense. Though I guess that relationship to me doesn't make a whole lot of sense. There's a lot of relationships in this market that don't make a whole lot of sense. And I guess it goes back to that phrase: the market can remain irrational longer than you can remain liquid. But I am looking at that as kind of a sign, not only the yield curve inversion, but this relationship between the Fed funds, I'm drawing a relationship between the Fed funds rate and the 10-year at this point, at these levels. And I'm saying now, this rally is a head fake. And I know people have come out and they think that they're bottom. And granted, they might be right on CPI numbers a little bit. They might see a pull down, despite the fact that I've seen like eggs took another shot up this month. So there's some interesting pricing in food that is happening this month in July. There have ramifications possibly at the CPI, and same with housing, because housing seems to still go up even though the amount of contracts are down, but housing itself is still going up. And I don't know what that is in the rental market because I'm not in the rental market right now. I haven't been looking. But, because you got owner's equivalent rent. So I don't know what kind of like psychology is going on there over the last couple months. So, but the point being is even if you get like a CPI number that comes down and you can get a market rally, this interest rate hike here will put us at the same level that we were at the last, I guess you call it recession, when things started really popping off, when you started having the repo market kind of go crazy, when you start having this huge downturn, it kind of broke what was going on. And we're going to hit that level. And the only difference, or one of the differences, we have a lot more malinvestment, but we also have, 2-3 times the money supply almost. I mean, not to mention people are way further in debt. People are in like less solidified positions. People have got 2-3 jobs or whatnot. A lot of people do. But, so my contention is that we're in a worse off position the last time we were even sniffing at this rate, at the Fed funds rate, which when they do that has ramifications in other markets as well. And you'll see that in the housing market. So I'm still contending that the housing market's been popped, and we still haven't seen those prices really. We haven't seen the air come out of that bubble. It's like a little tiny pinprick. I keep dropping my phone. And my contention is that the market itself is broke, and we're seeing this rally, and you have some guys coming in there and they're calling this the bottom. But I'm saying it's not the bottom. This is a false bottom, that we're going to have a flush out here soon. And it's going to come, and it's going to be speedy, and people are not going to be prepared, because I think people have now reverse thinking that this is all over. But once you get to a certain interest rate, like I've talked about, like this has ramifications on the debt marks. This has ramifications on companies accessing capital, and a lot of companies that are zombie companies in a sense, that are operating based off that cheap money that they can get access to. Now, we've only seen an inkling of that. We've seen a certain sector, especially the crypto sector, where this is really played out and is still playing out. Now, where's the next thing? I don't know particularly for sure. Because it's a highlighted market, the housing market's just easy to look at, and it was one of the, it was a key thing in the last giant crash in 2008. So we kind of look at that, and we kind of understand the mechanisms of it, and so we can look and see what's happening there. So I look at that, but there are other things that are going on, especially when you talk about consumer discretionary spending. When we start looking at inflation, because I'm also trying to keep an eye on the relationship to, not just when they give out retail sales numbers. I don't care about the end dollar amount. I'm looking at what goods are they able to buy. Are they just spending more for less goods? Is people's purchasing ability being narrowed into certain groups of goods and services, not based on their own wants and desires, but based on the lack of purchasing power? So I'm looking at all this stuff, and it doesn't look good, despite what CNBC and them will tell you. And when will the market correct, and when will the market really snap and have one of those moments where it's just like, things aren't good, we need to really have, I don't know. But we're at that point now, again, where bad news is good news and good news is good news in the market. You have companies that, I guess, they're beating the estimates, but they're not good. They're not good beats, you know what I mean? The estimates are horrid, and you do a little bit less than being a steaming pile of crap, and it gives a catalyst for somebody to throw money in the market, which doesn't make any sense to me. We're still seeing the wrong type of earnings beats, or not, earnings estimate beats, because you put these estimates in. So some of these companies, let's take Netflix for instance, they lost 1 million subscribers, which I guess was better than losing 2 million, and somehow that's justification for that. To me, that's still an anti-growth mechanism, and that's happening. There's something going on in that company still, and it shouldn't justify a huge pop in the stock, or for that matter, a triggering mechanism for a rally in the stock market itself. In fact, in these downturns, there should be sector-specific rallies, like when you talk about like energy and a few other defense when there's a war going on. But it seems like everything over the last decade or so revolves around Fed policy, and even this does. Even these, I don't even look at these estimates really that significant. They're just triggering mechanisms, and also coupled with whatever the Fed's going to do. So people now, rightfully so, by the way, just maybe not on the timing, are anticipating the Fed coming back into the market, or they already still are, because obviously their balance sheet keeps expanding slightly here and there, and they hold significant treasuries, and they buy, they're involved in overnight lending and all kinds of stuff. But and God knows what some of those things are on the balance sheet. Who knows? And what other assets they have that aren't properly delineated on there. But they are, rightfully so, anticipating the Fed getting looser than they already are, reversing these rates, going back to zero, starting up QE. That will happen. Like, I don't know when. Most people are anticipating at the end of the year, beginning of 2023 already. So that's also a thing that is going on in the market. People have already think that the sell-off has been the capitulation point, and now is a time that the Fed's going to come in. But they didn't. This is not it. They will come back when we have some real pain. That's what's going to happen. You start seeing the pain. Right now, you would think, because we are feeling pain through inflation, but to them, that's not a bad thing. They actually enjoy a little bit of inflation, as we know. So until we have real pain, you have a real market fear in the market, real sell-off. And I'm not talking about what we've just seen. That was pretty orderly. But like a real capitulation moment. Like you might even hit a breaker. But like some real downward pressure, some real layoffs, some companies going bankrupt. Not just in the crypto. That's, significant. But when we go into different sectors, like I'm looking at the mortgage side of things still. Like there's been some layoffs there, but I'm looking at companies and various high-profile companies, filing bankruptcy or doing something. Then you'll see that moment. Maybe the official recession call. I mean, even though the White House has now changed the definition on that, even though, I might not necessarily agree with it, but this is just the basis of what has been conveyed over the number of years, is that 2 quarters of negative GDP in a row is technically a recession. That's what everybody's been basing their views off of for a number of years, and now they're just trying to change it. And inevitably, we're probably going to have a negative quarter again. Will that be the tipping point where the market flushes down and then you have the Fed coming back? I don't know, but they are going to come back. they're addicted to this. The economy is addicted. We're like the best way to equate it is like a heroin addict. You get it, and we have to operate off those hits. If we don't get a hit, we die. And every time we need those hits, again, it has to be coming in greater and greater capacity. So we need a greater and greater dose. So the next one might possibly, and I'm thinking the next real hit, the next QE, that is when we have the dollar crisis. That because it's already setting up that way. We've talked about that a little bit with regards to some of the stuff that's going on with Russia, with the BRIC countries. Now you got Putin really buddying up to the Saudis, which is odd because, they've been longtime allies of the Iranians. But if Prince, or MBS, I'll just call him, MBS decides to start selling his oil or becomes a big influence in OPEC, diversifying their currency exchange for oil instead of just accepting dollars, or it's a huge risk, and they start accepting rubles or maybe a basket of currencies from the BRIC nations, and they start tying together a little bit closer than we would like, then you have some real issues here. On another front, I've heard that there's been a deal struck with, speaking of foreign policy, with Trump and DeSantis. So Trump more than likely is running in 2024, and then DeSantis will be his running mate. But I'm going to leave you there with that little nugget, and I'll talk to you later. Peace.